In this chapter, we will continue talking about the accounting equation, and we will talk about the recording process. We'll discuss and define what an account is. Then we will explain what the differences between debits and credits, and then we will continue to the various steps in the recording process. At the end, we will talk also about the journal, the ledger, and the trial balance. To start with the account, when we talk about the account, we're talking about a specific account. For example, cash. Cash would be an asset account. It could be a liability account, such as accounts payable. It could be an equity account, such as common stock. One of the simplest ways of representing an account is the T form, is the T account. So, and the reason why we call it like that is that it has a T-shaped. Basically, we have the name of the account, let's say cash. We have the debit side and the credit side. Now, to make it clear, debits and credits, they do not mean increase or decrease in a certain account. They simply mean left and right. So for instance, in English you say to the left or to the right. In French you say à gauche, à droite. In accounting we say debit, credit. It's as simple as that. You say you can debit an account, or you put it on the debit side, or you can credit an account, or you can make the entry at the credit side. That would be to the right. And the end here, so you have the debit, the credit, and then here you have the balance. So for example, let's look at the transactions that relate to cash, to the cash account from the previous example. So basically here we have a list of transactions that involve cash. For cash and assets, debits increase assets. So when you talk about an increase in a certain asset, like cash, when you have an increase in cash, you make the entry, or you put the amount on the debit side. You debit cash, that amount. If you have a decrease in cash, you credit cash, that amount. And it also means this other way around. Basically, if you debit cash, that means cash has increased, and if you credit cash, it means cash has decreased. So it goes in either direction. So let's look at this one. This example here, for example, in transaction 1, owners of SoftByte invest $15,000 cash in exchange for common stock. And here we are only looking at the cash account. We're not looking at the two accounts. So as far as cash is concerned, cash has increased by 15,000. Cash is an asset account, and debits increase assets. So this is why the 15,000 here were on the debit side. In the second transaction, SoftByte pays salaries expense in cash for $7,000. Now, when they pay the expenses in cash, cash has decreased by 7,000, and this is why we have credited the amount to cash. So as you can see here, the increases, all the increases here, they go to the debit side, and the decreases they go to credit sides. And this works only for this. In this case, we are only talking about asset accounts. We will talk about the remaining ones shortly. Now, debits and credits, they basically they are the basis of the double entry accounting system. And the reason why we call it like that is that at all times, the total debit must equal total credit. So for each transaction, at least one debit account will be involved, and at least one credit account must be involved for each transaction. So in this case, the effect of every transaction, so basically every transaction has an effect on at least two accounts. It could be one or more debit accounts or one or more credit accounts, and those will the total of the debit accounts of the debits and the credits must always be equal. As you can see here, for this transaction, for example, we have the company has bought supplies for $2,000 in cash, and the remaining 1,000 was on account. As you can see here, you look at the two sides of the equation, the total debits are equal to the total credits. Again, they must always be equal after each transaction. Whenever we have a debit account, whenever we have debits that are more than credits, the account is said to be a debit account. When we have more credits than debits, then we have its credit account. So here in this case, for example, transaction 1, we debited the account 10,000, we credited the account 3,000, and then third transaction we debited it again 8,000. So the total here will be, it's very simple. We add those two sides, so each side alone. Here we have 18. Basically we have the account, and by the name, the account name is always capitalized. We have 10,000, 8,000, so it's 18,000 on the debit side, and we have 3,000, that would be 3,000 on the credit side. As a result, the difference between the two is 15,000. And because in this case we have more debits than credits, we say that this account has a debit balance. On the other hand, when it is the other way around, here we have again account, we have here a total of 11,000, here it's a total of 10,000. The difference between the two, it is 1,000. So the difference between this one, so it's 11,000 minus 10,000, it's 1,000, and because credits are greater than debits, this account has a credit balance. Generally speaking, we have the account can have the normal balance either on the debit side or on the credit side. And like we said in the previous example here, for example, the normal balance was credit. So when you have the normal balance is credit, you have more credits than debits. So the credits are higher than debits. When you have the normal balance is debit, it means you have more debits than credits. Here, the normal balance is always on the increase side. What do we mean by that? If the account increases, like as you remember in the cash example, we had cash. So we had here cash. Let's say that we have 10,000, and then it was debited 7,000. The balance here will be 3,000 for cash, and this balance here, if we increase, if cash increases, it will be debited. This is why the normal balance is always on the increase side of the account. Like we said before, debits will be increased by debiting the account. I'm sorry, for example, a debit account increases with debits. So assets are debit accounts. So debit would increase that account. Credits, they would decrease the account. Liabilities are the other way around. So for liabilities, they have more credit, they should have more credits than debits. And in this case, the normal balance is on the credit side. So whenever, and the it's on the increase side, which is, in this case, it's on the credit side. As you remember, credits and debits, they do not mean increase or decrease. They simply mean this is left, right, left, right. Now, the way they affect each account is different. That depends on whether the account was a credit account or a debit account. Assets are debit accounts, liabilities are credit accounts. Now, the easiest way to think about this is in terms of the accounting equation. And we'll see that soon. Stockholders' equity is slightly different. Stockholders' equity, we need to think about it from the perspective of how each account, like common stock, retained earnings, etc., how they affect stockholders' equity. So dividends and expenses, when they increase, they decrease stockholders' equity. Revenues, the more revenues you have, the higher stockholders' equity. And same thing can be said about common stock. When common stock increases, stockholders' equity increases as well. So it has basically the same behavior. It would be like, in this case, like liabilities. So common stock has a normal credit. The normal balance is on the credit side. Retained earnings are the same. Revenues are also the same. They have normal balance. Dividends and expenses, because when they increase, stockholders' equity decreases, they have the opposite effect on stockholders' equity, and as a result, they are debit accounts. This is what we were talking about revenues and expenses. So, why is that? Let's remember what was on the expanded accounting equation, and then we will understand it better. We had assets were equal to liabilities plus stockholders' equity. Okay? And this is why. This is on the left side, this is the right side, this is debits, credits. Now, like we said, revenues, for example, when they increase, stockholders' equity increases, and so the effect is positive, and it has the same kind of, it is of the same kind. And this is why revenues are, they have a normal credit balance. On the other hand, expenses, when they increase, stockholders' equity decreases, and this is why they are on the debit side. This is here just a summary of all these accounts that we have been talking about. And this one is more, it shows also the accounts of the balance sheet and the income statement. When we have debits, when we debit an asset, it increases. When we debit liabilities, equity, or expenses, they decrease. When we debit an expense, it will increase. Dividends also would increase. Credits are the opposite to this one. Again, let's now look at the expanded accounting equation. We had assets are equal to liabilities plus common stock plus retained earnings plus revenues minus dividends minus expenses. Now let's put all the items in, all these items in positive. So the dividend here, we'll bring it to the other side of the equation, and we do the same thing for expenses, and we end up with assets plus dividends plus expenses equal liabilities plus common stock plus retained earnings plus revenues. Now, at this point, this is where we draw the line basically. We have, so we have the left side, debit are left, credits mean right. The left side of the equation, those are debit accounts, credit accounts. It's as simple as that. So all we need to do is to put all the items, all the elements of the expanded accounting equation in pluses, and then the left side of the equation is left, which is to me debit, right side of the equation is right. That would be credits. At this point, so this is exactly what we have just mentioned. At this point, we can see how they would look like. So we have here plus, plus, equal, and here we have all pluses. When we have debit under assets, debits would increase, or if we want, let's put them like that, increase. Credit would decrease assets. Same thing here. Now on the other side, I have it the other way around. Debits would decrease, credits increase, because those are, as we said, credit, debit. So in this case, once again, we have credits would increase those accounts, debits would decrease them. So debits, would they increase both assets and liabilities, decrease both assets and liabilities, increase assets, decrease liabilities, or decrease assets and increase liabilities? And the right answer is C. Debits will increase assets. On the other hand, credits will increase liabilities. So debits will decrease liabilities. So the correct answer is C. Another question is, accounts that normally have debit balances are assets, expenses, and revenues, assets, expenses, and equity, assets, liabilities, and dividends, assets, dividends, and expenses. And the right answer here is D. As you remember, those are the accounts that are on the left side. After we put all the elements in pluses, those will be the ones at the left side of the equation. This slide here shows the relationship between the various accounts and the various statements and the balance sheet. So basically we start from the income statement, we get the net income or net loss, depending on whether we have more revenues or expenses. And then that would lead to that would give us the information needed for earnings, for retained earnings, to calculate retained earnings using both this one. So it's using both the income, the net income or net loss from the income statement, and the dividends, along with the common stock. That would give us the stockholders' equity section of the balance sheet. This is a summary. It's similar to what we said before, just a summary of debits and credits. And as you remember, if you get confused with those minuses here, what these minuses mean simply that they have a negative effect on stockholders' equity, and as a result, they work in a different, in the opposite direction from stockholders' equity, in that stockholders' equity is on the right side of the equation, so it is a credit account. Dividends and expenses are debit accounts, although they are here on this side, but because of the negative. So debits will increase assets, credits decrease assets. Liabilities, they decrease with assets, with liabilities, they decrease with debits, increase with credits. Common stock, debits decrease, credits they increase. Retained earnings, same thing, minus plus. Dividends will be the opposite. It will be an increase with debits and decrease with credits. Revenues, again we go back to minus plus. Expenses plus minus. Now, Kate Brown, president of Harriet is Inc., has just rented space in a shopping mall in which she will open and operate a beauty salon. A friend has advised Kate to set up a double entry set of accounting records in which to record all of her business transactions. Identify the balance sheet accounts that Harriet is Inc. will likely need to record transactions needed to establish and open the business. So those are not all the accounts, but are the most likely accounts. She might have different ones, but just as an example, for example, and we need to also state whether each account is a debit or credit. So we'll start with assets, for example. The first one that comes to mind, of course, is cash, and cash is a debit account. The other one would be, for example, as a hair salon, Kate would need supplies as well as equipment. All asset accounts in this case, so those are all asset accounts and they are debit accounts. When we talk about liabilities, Kate might need, for example, to take a loan or to buy supplies, etc. on account. So that would be notes payable or accounts payable. Both accounts are credits. And because she will have investors investing in this business, she might have, for example, common stock. Later on, she would have also revenues and expenses added to that. Now we get to the recording process. The main steps in the recording process are what we have been doing so far, which is analyzing the transaction. So whenever we get a new transaction, whenever we have a transaction, we analyze it. Actually, it all starts when the company receives, for example, it all starts with a business document, such as a check, an invoice, a sales slip, etc. Then the transaction is analyzed. After that, we start making journal entries. So we enter that information in the journal, and the last step would be to post that information and to transfer it from the journal to the ledger, where we have to individual accounts in the ledger. So to start with, what's the journal? Well, the journal is called the Book of Original Entry, and the reason we call it the Book of Original Entry is that this is the first time that we make any record or we start recording a transaction or an economic event that took place. So this is where it all starts. And the journal keeps track in a chronological order of all the transactions that have happened. So it's one of its advantages is that it keeps them in a chronological order, which would help later on identify which transactions happened first. Many companies actually, they also have more specialized journals, such as sales journals, cash receipt journals, purchases journal, etc. Those they have more information, they might have more details. But all companies have the general journal, which has it has a space for date, so it includes the information about the date of the transaction, the accounts that were involved in this transaction, as well as an explanation of what this transaction was about. It also has two amount columns, one for the debit and one for the credit account. Now, the use of a journal helps also in preventing or at least identifying errors whenever they occur, because it takes advantage of the fact that debits must always be equal, so it's easy to compare the debits and the credits of the transaction. Here, it is important to say that the journal also it records the effect of the transaction on the accounts that are involved. And usually for each transaction we have at least one account, one debit account that is involved, and at least one credit account that is also affected by that transaction. And the journal captures the whole effect of this transaction on both accounts. As you remember, we said that in the accounting with the when we're analyzing transactions with the accounting equation, we said that any transaction that happens must affect at least, it has a dual effect basically, which is to mean it affects at least two accounts. This is an example of when we make a simple journal entry. So on September 1st, stockholders invested $15,000 cash in the corporation in exchange for share of stock, and SoftBite purchased computer equipment for $7,000 in cash. Now, when we journalize transactions, we enter each transaction separately. We don't try to combine them here, for example, and say that we are left with $8,000 cash. No, we have to make an entry for each transaction separately. This is, as you remember, it's the chronological order of transactions. Now, the first thing that you enter is, of course, the date. After that, the account that is to be debited, and then the account that is to be credited. In this case, it's cash and common stock. As you remember, cash in this case has increased because of the investment of the shareholders in the company. The company received $15,000 in cash, so the cash account has increased by $15,000. And cash is an asset account. Assets are, they increase with debits, so we debit cash 15,000. Common stock is an equity account, and and it is a credit account. So because it has increased, common stock has increased by 15,000, then we need to credit common stock 15,000. Now after that, we enter the second transaction. The second transaction was where SoftBite purchased computer equipment for $7,000. In this case, equipment, which is an asset account, has increased for $7,000, and as a result, we debited equipment $7,000 and we credit cash $7,000. As you remember, there's one thing that is still missing, and that is here, this part here. What do we enter here? We need to enter an explanation of what this account is about. What is this transaction? Why have these accounts changed in this way? Now this is a simple transaction. And why do we call it a simple transaction? Well, simply because it has one account that was debited, one account that was credited after, within each transaction. So this is the first transaction. This is the second transaction. In each one of them, only we had one debit account and one credit account. And as you can see, for each transaction, total debits for transaction 1 equal total credits. Same thing here. Now, as you can see, the reference is left blank. And this reference will be left blank until later on we include until we transfer this information to the general ledger, where we get the reference here and we put it here. We'll talk about that soon. Now, an important thing is, as you can see, there's this indentation here, and we always record the debit account first. As you can see, this is the debit account here, and this is here the debit account, and then we indent a little bit the credit account, and this is the one like common stock, or in this case it's cash. The reason why we indent it is to show that this is the credit account. And finally we put the explanation. J1 here, this one refers to the page of the journal. So when you talk about J1, this is the first page of the journal. Now this is a similar thing, however this is a compound entry. So on July 1st, Butler Company purchases a delivery truck costing $14,000. It pays $8,000 in cash and agrees to pay the remaining on account. Now, what accounts were involved in this transaction? First, we have equipment. So the first transaction that was involved is equipment. And how do we make the journal entry? Once again, we have the date, it was on July 1st. The account name is equipment, because equipment has increased. We debit equipment 14,000. What happened to cash? Cash has decreased by 8,000. The company paid in cash, so the cash has decreased 8,000, and when assets decrease, we credit the account. So we credit cash. As you see, we have also indented cash to the right to show that this is the right, which is to mean it's the credit account. Now, what about the 6,000? It's on account, and when we have like a purchase on account, this is accounts payable. Accounts payable is a liability, and it has increased by 6,000. And when liabilities increase, we credit the account. So we credited the liability account, accounts payable, for 6,000. As you can see here, credits and debits, they do not mean an increase or a decrease. In this case, this account was credited, however, it has decreased. Whereas this one, it was also credited. The liability, accounts payable, was also credited 6,000, but in this case, it indicates that the account has increased, in fact. And then you put the explanation that this account here, you put the explanation. For example, that the account that this transaction shows it was purchase of equipment on cash and account. Now, we have been talking about the journal. The journal keeps track of the transactions in a chronological order. So the journal deals with transactions. The general ledger deals with individual accounts. So it deals with individual assets or liabilities or stockholders' equity accounts. Basically, it keeps in one place all the information about the changes in specific account balances. Here too, we have companies who might have more specialized journals, ledgers, such as they usually call them subsidiary ledgers or subledgers, and those they would include, for example, the purchases ledger, sales ledger, etc. They provide more information, more details about individual accounts than the general ledger. However, all companies, they have the general ledger, and in this case, whenever we talk about the ledger in this course, we are talking about the general ledger. Now, the general ledger contains information on all the accounts, all the asset accounts, all the individual all liability accounts, and stockholders equity accounts that are used by the company, by this company. And usually the ledger organizes those accounts in the based on how they appear on the financial statements. We start with the balance sheet accounts, so we have assets first, liabilities, and then stockholders equity accounts, and after that we have the income statement accounts. Now every company has a chart of accounts. The chart of accounts is simply a list of all the accounts that a company uses. It just has the number of the account and the account name. Once again, they are organized in the order that they show up on the financial statements. First we have assets, liabilities, stockholders equity, and then we have revenues and expenses. Now the number of the accounts, they depend on the level of detail the management wants. So for example, you might have one account for utilities or separate accounts for expenses, or for utility expenses such as gas, electricity, and water. It also depends on the size of the company. So you don't expect a company like Procter & Gamble or Walmart to have the same number of accounts as a small company. Plus, it depends also on the line of business. If you have a service company, let's say a legal firm, they would only have service revenue. They're not selling products. But a company like Walmart or Best Buy, they might have both. They have sales. For example, let's say Best Buy. They have sales from selling the products from their in their showrooms and website, as well as service revenue that comes from the Geek Squad for fixing electronics. Now the numbers that appear next to each account, there are gaps in these numbers, and those numbers are not standardized, so they depend on each company. So those gaps between each account numbers, they are left intentionally to allow for future expansion. So for example, let's say in the future you didn't have a certain asset account, like you didn't have inventory, then because of the gaps between the accounts, you will be able to insert that account on the chart of accounts. Now the chart of accounts help us identify the location of each account in the general ledger, because they are organized in a way in the same order. We talked about the T form of the account. Here we'll talk about a standard form of account. It's also called the 3-column form of account. It has the reason why we call it like that is that it has 3 columns that include monetary value. We have the debit column, we have the credit column, and then the balance. So after each transaction, as you can see, this is transaction that happened on June 1st, June 2nd, June 3rd, etc. So we have June 1st, 2nd, 3rd. So after each transaction, we include, or we enter the change that happened. In this case, in the first transaction, the change was an increase in cash for 25,000, and so we enter it on the debit side. Then we calculate the balance. It's 25,000. On June 2nd, we had a credit that was posted to cash. In this case, cash has decreased by 8,000, and we recalculate the balance and we find that it was 17,000. So as you can see, it is the balance is calculated after every transaction. Now, in general, the explanation is used to provide additional information. However, in certain cases, it's not, and we will see soon why. And the reference also, we will see see when it will be used, or what to include under reference. So basically, the first time we include the debit amount and debit and credit and balance. So we include the amount, under the correct column, and we have the date. This number here, this is the number of the account as it shows on the chart of accounts. The next step is posting. This is where we transfer the information from the journal to the ledger accounts, the individual accounts in the ledger. We first transfer the information for the debited account. We start here with the date, so we have the date, we have the debit amount, the balance, we include the reference of the journal page, and then the second step is we take this number here, the account number, and we take it to the reference, we put it here in the reference column, and the reference column of that transaction. So we take it for that account, we take the number and we link, we put it under the reference column. The reason why we do that is we want to link the information in the ledger and the journal in the two directions. Now we can we have linked the journal to the ledger, and we linked the ledger back to the journal. And then in the ledger we put the appropriate columns. We put the amounts like this is for the, and then we deal with the credited account. In this case it's common stock. So again we put the date, amount under the credit column, we put the balance, we put the reference, this is the journal reference, and then again the last step would be to take the account number, the credited account number, and then we put it under the right column, under the reference column in the journal. Now most of the time the explanation are not used in the ledger, as they can be easily traced back to the journal entry, so there is no need for redundancy. Here we will start with a few examples of how the recording process actually takes place. So the first step we always need to do is to identify the accounts that are affected by the transaction. Then we need to see how they changed, did they increase or decrease, and finally we translate that into debits and credits. We write the journal entry. So for example, for this first example, we know on October 1st, C.R. Bird invests $10,000 cash in an advertising company to be known as Pioneer Advertising Agency. So what accounts do we have here? We have cash and we have investment. When we talk about investing, we're talking about common stocks. So we have cash has increased by 10,000. Stockholders' equity, here it's common stock. Common stock has also increased by 10,000. We write down like we did before the accounting equation, and this is how we do the analysis. Cash has increased 10,000, common stock has increased 10,000. We put here the explanation. As you remember, we always need to keep track of what caused the change in stockholders' equity, so we have issued stock. Now we translate that into debits and credits. What increases cash? Cash is an asset account. Debits increase assets, so we debit the account cash $10,000. On the other hand, common stock is an equity account, and as a result we credit, because we have an increase in common stock, which is a credit account, we credit common stock 10,000. Next, what we do is from this one we post it to the ledger. Here, as you can see, we have the credited account, the debited account, we have we have the debited account and the credited account, and we have, this is the amount that was debited, this is the amount that was credited. Let's do another one now. On October 1st, Pioneer purchases office equipment costing $5,000 by signing a 3-month 12% $5,000 note payable. At this point, let's not think much about these. This is not an important information at this point. We will be talking about that in details later on in future chapters. For now, just think about it as they purchased equipment and they signed a note payable for that. So the accounts that are involved are equipment and note payable. We know what happened to the asset account equipment. It has increased by 5,000, and note payable has also increased by 5,000. As a result, we know that assets, when there's an increase in an asset, we debit the account. So we debit equipment 5,000, and liabilities, when they increase, we credit the account, so we credit notes payable 5,000. The journal entry would become equipment on October 1st, equipment. We debit equipment 5,000 and we credit notes payable 5,000. Again, the explanation is that this is issued or let's say signed a note for office equipment. Again, the last step would be to post this information to the ledger. We look at each account. This account equipment, it was debited, so we put the amount under debit. Notes payable was credited, so we put the amount under the credit side. On October 2nd, Pioneer receives a $1,200 cash advance from Arnox, a client for advertising services that are expected to be completed by December 31st. Now, the accounts that were involved are cash and unearned service revenue. And why do we call it unearned service revenue? This is a service that is to be provided by December. And because we haven't finished it yet, this is something that now we owe to the customer. So the company, now Pioneer, owes Arnox the advertising services by December 31st. As a result, this is a liability. Unearned service revenue is a liability, and the debt has increased, or the liabilities, they have increased by $1,200. We don't consider it as revenue yet because we have not provided the services until by the end of the month. So we have cash has increased by 1,200, and the liability unearned service revenue has also increased by $1,200. Again, the reason why we call it unearned service revenue, because this is a service that will not be completed in this current accounting period. Rather it will be completed in the future. So the money that we have received, we did not earn it yet. We will earn this money. It will become a revenue, and we will earn this revenue once we have completed the service. Now, assets. We know that debits increase assets. So we debit cash $1,200, and credits increase liabilities. So we credit unearned service revenue $1,200. Again, in this case, we have debited cash $1,200 and credited unearned service revenue $1,200. And the explanation here would be received cash from Arnox for future services. We post these accounts. Now we have debited cash, so we put it also under debit. As you see, we put them in a we put them one after the other, but because they are both debits, so we put it on the debit side right after the last entry. Here it was credited, so we'll add it under the credit side. On October 3rd, Pioneer pays office rent for October in cash $900. So the accounts that are involved in this case are rent expense and cash. So what happened to the rent expense? Rent expense has increased by $900, whereas cash has decreased by $900. And cash is an asset, so cash has decreased by $900, and expenses, rent expense has increased by $900. Now the minus here, it reflects the negative effect that this transaction has on stockholders' equity. So in general, stockholders' equity has decreased by $900. The expenses themselves, they have increased by $900, and here we write the explanation to make sure that we keep track of the transactions or the reason why stockholders' equity has changed. Now, credits decrease assets. So we credit cash $900. On the other hand, debits increase expenses. So we debit rent expense $900. So the journal entry would be debit rent expense $900 and credit cash $900. The explanation would be paid October rent in cash. And then we post this information to the ledger. As you can see here, this was debited here, and this one was credited to cash. On October 4th, Pioneer pays $600 for a 1-year insurance policy that will expire next year on September 30th. In this case, Pioneer has paid in advance a 1-year insurance policy. Now, this is not considered as an expense. Why? Because Pioneer has not utilized this insurance policy. As a result, this insurance policy is considered as a prepaid insurance expense, and this is an asset. Later on, Pioneer will be using this asset in their business to generate revenues. As a result, the cash has decreased $600, and the asset prepaid insurance has increased by $600. Assets, so in this case, we know that debits increase assets, so we debit prepaid insurance $600, and credits decrease assets, so we credit cash $600. The journal entry would be, remember to always put the date. We have October 4th, we debited prepaid insurance $600, and we credited cash $600. Explanation would be paid 1-year policy in cash, effective date October 1st. Then we post this information to the ledger. Again, this was debited, this is credited. On October 5th, Pioneer purchases an estimated 3-month supply of advertising material on account from Aerospace for $2,500. So what are the accounts that are involved? Supplies and on account. So what happened here? The company supplies, the asset supplies has increased $2,500, and the liability accounts payable has also increased for $2,500. Now we have, the company has more debts. This transaction has increased the liability of the liabilities of the company. At the same time, it also increased the assets of the company. So as a result, we have under assets, we have supplies increased $2,500, and liabilities have also increased $2,500. We know that debits increase assets, so we debit supplies $2,500, and credits increase liabilities, so we credit the liability accounts payable $2,500. The journal entry would be October 5th, supplies was debited $2,500, and accounts payable was credited $2,500. The explanation is purchased supplies on account. Then we post them to the appropriate accounts in the ledger. As you see here, also remember that at all times, for all the transactions, we always have the total debits are equal to total credits for each transaction. On October 9th, Pioneer hires 4 employees to begin work on October 15th. Each employee is to receive a weekly salary of $500, etc. However, because they have not started work yet, they haven't provided any services to the company, they did not get paid any money from the company, there is no need to record that transaction, as the financial position of the company was not changed. No accounts, there was no changes to any of the accounts. As a result, we don't record that transaction. On October 20th, Pioneer's board of directors declares and pays a $500 cash dividend to stockholders. What are the accounts that are involved in this transaction? We have cash and dividends. So what happened to cash? The company's cash account has decreased by $500 and dividends have increased by $500. Now, as you can see here, dividends, they have increased, but this minus here, it reflects the negative effect of dividends, of the increase in dividends on stockholders' equity. As you remember, when there's an increase in dividends, stockholders' equity will decrease. Now, cash is an asset. Cash has decreased. Credits, they decrease cash. So we know that we will credit cash. Debits have increased, so we debit. Dividends have increased, so we debit dividends 500. The journal entry will be dividends is debited. The dividends account is debited 500. Cash account is credited 500, and the explanation would be declared and paid a cash dividend. Once again, we post this information to the appropriate account in the ledger. On October 26, Pioneer owes employees salaries of $4,000 and pays them in cash. So what did we do here? We paid the employees that we hired earlier. Now is the time when we actually record the transaction. So we pay them in cash, so cash is involved, and salaries and wages expense is also involved. What happened to cash? Cash decreased 4,000 and our salaries and wages expense has increased 4,000. Once again, the minus here is to indicate the negative effect on the stockholders' equity. So expenses, they have increased, and debits increase expenses. So we debit salaries and wages expense 4,000 and cash is credited 4,000. So this is the journal entry. Once again, as you remember, it's always total credits are equal to total debits. So we debit salaries and wage expense and we credit cash 4,000. Then we post them to the appropriate account in the ledger. On October 31st, Pioneer receives $10,000 in cash from Copa Company for advertising services that were provided in October. So those are services that the company earned in October. They received them in cash, so cash and service revenues are the two accounts that are involved. Cash has increased and service revenue has also increased. Again, remember that you always need to include an explanation of why the change to stock of the reason of change in stockholders' equity. Now we know that cash is an asset, debits increase assets, so we debit cash 10,000. On the other hand, service revenues are credit accounts, so we credit and they increase with credits, so we credit service revenue $10,000. The transaction would be October 31st, cash was debited 10,000, service revenue was credited 10,000, and the explanation would be received cash for services provided. Then we post them to the appropriate accounts on the ledger. Now we go back to our old friend Kate Brown, who opened the hair salon, and she has the following transactions in her journal, and she's going to post the entries to the cash account. So in this case, we are only looking at the cash account. In the first transaction, so we need to locate the debits and credits that were so the amounts that were debited to cash and the amounts that were credited to cash. In the first transaction, cash was debited 2,280. So we put it under debit. This is March 4th. It was we enter it as debit 2,280. The second transaction included a payment in cash. So cash was credited 400. So we put it here under cash, credited 400 on March 15th. The last one was also a credit of $92 to cash on March 19th. We add these and subtract these. So we add the debits and subtract credits from cash because cash is a debit account. So we add the debits, we subtract credits, and we end up with the ending balance. The journal, this is how the general journal looks after all the transactions that we just made in the previous examples. You have each account. We have each transaction one by one, as you can see. Transaction 1, transaction 2, etc. We have the amount that was. We have the account that was debited, accounts that was credited, the amount debited, the amount credited, and as you can see, it's always total debits equal total credits. So debits are equal to credits for each transaction. And here we have on the reference, we have the accounts that are involved. So those are the account numbers for each account that was debited or credited. And then this is how it looks on the general ledger. Remember, the journal deals with transactions with journal. So the journal entries, they deal with transactions. The ledger basically is the group of accounts. So it deals with individual accounts. At this point, we have the changes to each account for each one of them, cash, etc. And this is the ending balance for cash, ending balance for supplies, etc. This information is used later on to prepare the trial balance. And as you can see, the ledger is the accounts in the ledger, they are posted in the order as they appear on the financial statements. We start with assets, then we have liabilities. So we have here liabilities. We started with assets, we have liabilities, we have stockholders' equity, then we have the income statement accounts, revenues and expenses. So the trial balance is a list of the accounts and the balances at a specific date. This is like a snapshot. So you see on October, so on October 31st, the balance for the cash account was 15,200. On that day also, accounts payable account was 2,500. So this is how you do it. It basically lists all the account in the order that they appear in the ledger, and then the total, as you can see here, the total debits must equal the total credits. And if they don't, if they are not equal, it simply means that we have made a mistake. So first thing you do is you list all the accounts, then you add them up, you add the debits and you add the credits. So you add the debits here, then you add the credits and you compare the two numbers. They must be equal. So in other words, the trial balance proves the mathematical equality of debits and credits after posting. And under the double entry system, this equality occurs when the sum of all the debits are equal to the sum of all the credits. In this case, if they are not equal, it will help us detect such error or such mistake. Let's say that you forgot to post one of the debits to cash or one of the credits, etc. That will create an issue. However, the trial balance is not foolproof in that it may balance even when there are certain mistakes. Let's say that you forgot to include the whole transaction. Still, the total debit will always be equal, will be equal to the total credits. Or if you credit the wrong account or you debit the wrong account, as long as total debits is equal to total credits, the trial balance will be it will still balance. If, let's say, a certain journal entry was posted twice, still the total balance, the total credits will be equal to total balance. There are some I just want to mention here that errors usually they are unintentional. Irregularities are when there is the intention of making this mistake. So in this case, like this question, a trial balance will not balance if a correct journal entry is posted twice, the purchase of supplies on account is debited to supplies and credited to cash, $100 cash drawing by the owner is debited to dividends for $1,000 and credited to cash for $100, the $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. Which one is the wrong one? Let's start with them one by one. The correct journal entry is posted twice. Still, in this case, we have total debits equal total credits. So this is not the right answer. It will balance here. Will balance. The purchase of supplies on account is debited to supplies and credited to cash. Originally, the way it is supposed to be, it's supposed to be debited to supplies but credited to accounts payable. However, in this case, it was credited to cash. But the total debits will be equal to total credits. So the account name will change, but the sum of all the credits and all the debits will be equal. So this one also will balance. The third one is $100 cash drawing by the owner is debited to dividends for $1,000 and credited to cash for $100. Now this one will not balance. So this is the right answer. Why? Because the debits here are equal to 1,000, whereas the credits is 100. There will be a difference of $900. The last one is $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. Again, debits are equal to 45, credits are equal to 45. So the trial balance will balance as well. So this is not the right answer. Remember, you need to always consider, you need always to look at the debits and credits in order to see whether it will balance or not. So let's do this trial balance. Let's prepare the trial balance. Like we said, you always start in the same order that they appear in the ledger. So the first one, you'll look at the account number. In this case, for example, the first one is 101. This is cash. And the amount is, cash is what? It's a debit account. so you put it under debit. Then the second one, so this is cash. Second one is, we look at accounts receivable. Then we have prepaid insurance. After that, we have equipment, notes payable. So as you see, we started with assets. Then we have liabilities, and we'll see, etc. Then we have liabilities, and then equity. Finally, we end up with revenues and expenses. This is in general the order. So we have next, after notes payable, we have accounts payable. After accounts payable, we have salaries and wages payable. Next is, we have common stock. We have dividends, service revenue. Then we have the expenses. So we have utilities expense, and last is salaries and wages expense. Now again, what do you do after you prepare? This is how we prepare the trial balance. We listed all the accounts, whether under debit or credit. So for example, here we know that expenses are debit accounts, so we put them under the debit here, debit column. We have common stock is a credit account, so we put it under the credit. And finally, what we need to do is to compute the two here, the totals, and we compare total debits to total credits, and they must be equal. Otherwise, we know that we have made a mistake. Remember, we put the debit account under the debit column and credit account under the credit column. That's how we prepare a trial balance, and we check and compare that the trial balance is actually balanced.